We specialize in doing goals-based financial planning for our clients, most of whom, as you said, are high net worth individuals and families, many of whom know us locally and personally. Here in Southeastern Michigan, we're based in Ann Arbor. We call ourselves an ensemble practice, which means we're all working together. The clients belong collectively to the firm. We're all working as a team to service those clients. And because we think about servicing clients in that way, it allows us to provide uniform and consistent investment management from my team, regardless of which advisor over on the other side of the office is managing the relationship.
And in this current economy, what are you seeing take shape?
When you do the research, though, I do think that earnings have kept up, right? We're seeing it. Sure, there are always some companies that are overpriced and there are others that are underpriced, but there's still a good amount of value to be had in owning equities if the long-term goal of your portfolio is to generate growth. And since it is clear that while the Fed might not be cutting rates as early as many in the stock market would prefer, it does seem that rate hikes are over. And in a stable rate environment, corporate America can process through their quarterly processes and their balance sheet issues when they're fairly confident that they can issue debt at these levels, right? So I see that it's a good thing that rate hikes are over. Of course, any long duration growth investment person would love for rates to be 100 basis points lower than they are right now. But stability is better than nothing. So I'm cautiously optimistic that we should be able to process through a reasonably good economy over the next year or two. I think it's not going to be gangbusters, but things should be okay.
And are your individuals of wealth, are they showing concerns, or are they expecting a bull market?
You do high quality financial planning that can lead to a proper asset allocation. And then you also take into account how firm their stomach is, especially if you try to quiz them some and interview them on how did you feel in March of 2020? How did you feel in November of 2008? If you can kind of counsel through that process, you can land on an asset allocation that helps immunize a lot of that stress, right? But if they lose a lot, they might be in trouble. Well, then you can de-risk the portfolio, don't have too much allocated to stocks. And as I said, in this kind of fixed income environment, earn a fair rate of return on the ballast side, the bond side of the portfolio. Then even if you do go into a recession later this year or next year, and that comes along with it, say a correction or even a bear market on equities, well, if you don't have too much allocated to equities, the portfolio is still going to be okay. And we can prove that through good financial planning, both now in advance and when it's happening later. But we have folks who have saved millions of dollars, and they did it sometimes by just spending less than they earn for an entire lifetime. And now they have millions of dollars and they are drawing on those portfolios, and they know that, and they recognize that this is money that is going to, in some case, charities or children or grandchildren, and they are really just stewards of capital that isn't even theirs. That's how they think about it. And when a client is in that state of mind and that state in their financial plan, they could be 100% equities. They don't need to have ballast in their portfolio because it's not money that they're going to be drawing down on. And if they are in a state of mind that can also tolerate the volatility that comes with that growth engine, they can do it. Do a search that shows me all the accounts that have a little bit too much cash. So now we have that list of accounts that need to have work done on them. A different search might say, show me all the accounts that are overweight stocks versus bonds and other ballast by more than 3%. And then because we know our client accounts pretty well, we'll often have a sense for, because of the way that the market's been moving, chances are the things that are overweight right now are in the technology sector, for example. So The system shows me all the accounts that are overweight equities, and then I can apply some subjective knowledge of the whole ecosystem and say, all right, let's set up a directed sell for all the accounts that are overweight equities, sell this name that Andy has identified as something that we'd like to take profits off the table on inside technology. And the system can do that for you. And then the job as the human is to go check the system's work. But having that tech stack there to do the first 2 or 3 parts, do the filtering, set up the automated trade, it makes it possible for a 3-person team to manage the kind of assets and number of accounts that we're dealing with.
Incredible how technology has really facilitated smaller steps.
Yeah, I don't think it's possible to run a firm like this these days without embracing the use of technology. I think it's really inefficient and almost impossible otherwise.
How do you determine when to insource instead of outsource?
I have the CFA charter. I've learned how to do the whole, free cash flow models on spreadsheets. I could be spending hours of my time doing hardcore analysis on individual companies, but I'm also a generalist and I have a lot of other things to do with my time. And if I can find high quality research that's done by people outside of our firm that I agree with consistently over time, and I think it is done consistently over time, then that's a good place to outsource, right? Find a team of analysts that have their specialties, whether it's based on sector or geography or other things. Do the due diligence on their research, decide that you agree with it, and then if you do, pay some money to get access to that research for the next year, read it, consume it, and make decisions based on their work, right? Let those specialists be those specialists, and I'm the generalist who processes that information.
How do you approach due diligence on the investment side?
So in terms of finding research for the individual stock picking, you need to find, again, there are multiple different ways of doing stock analysis, and they are all valid in their own right, but you need to find something that fits with how you think about the world consistently so that you can lean on them to make decisions without finding yourself disagreeing with a piece of analysis three months later and then throwing the entire process out and having to start from scratch. So that's part of it, is find synergy or harmony with the outsourced, the team that you've chosen to outsource research to. When it comes to, then there are other parts of our clients' portfolios that are not individual stocks, and this is where operational due diligence is important as well. We don't use all individual securities throughout the entire portfolio. Even in the largest portfolio, we use ETFs in parts of equities, right? We might buy a few small cap stocks, but if we want more, larger weighting towards small cap or mid cap, ETFs make that much easier than trying to build a diversified portfolio of all individual securities. Same thing can be said for international exposure. I believe in currency hedging in developed international investing, which I know is a bit of a minority view. It's maybe a conversation for another day, but you can't do that on your own, at least not efficiently, inside of somebody's $1 million IRA. ETFs can.
I can't resist. And I have a quick question. What's your favorite currency to hedge?
The only time you want exposure to the currency is if you think that foreign currency is going to do better than your own currency. And if you live in a developed market and you're investing in a different developed market, there's no reason to think that other developed market is going to do better than yours over any long period of time. That whole argument goes away in the world of emerging markets, right? I think part of the investment thesis in investing in Brazil or China or India is that those entire economies are growing, they are still developing, and should be growing faster than the US or Europe or Japan. And in that case, you not only want to have exposure to the stock in that country, but you also want to have exposure to the currency in that country, and they should both go up, is the investment thesis in emerging markets. But in developed markets, you don't want the currency exposure. And ETFs are the only efficient way to do that inside accounts of the size that we're dealing with. Certainly on the bond side, we use a lot of ETFs there. They're more liquid than individual corporates and munis a lot of the time, so there are benefits of liquidity. But once you've decided to outsource not just the research, but the entire investment management process, whether it's a passive structure or an active ETF, you need to learn a lot about how those portfolio managers are doing their jobs. In the case of small caps, there are two big indexes in the world of small caps, the Russell 2000 and the S&P 600. They are different indexes. The S&P 600 has a profitability filter that leads to different performance in the looking backwards and should lead to different expected performance going forwards. That is an active choice that you have to make as an allocator to an external manager. What index do you want? You also need to think about how well it trades, how liquid it is, what the expense ratio is. There is real due diligence to be done, even in the most plain vanilla passive ETF strategies out there. And then, since there are things that are not just plain vanilla, the work stacks on even more. If you're dealing with fixed income ETFs, the indices can become very custom and nuanced, which is a good thing. They've developed high quality products that are useful to our clients and useful for the portfolios we're trying to build. But you better know how those things are built and how they're going to perform and how they fit inside the rest of the ecosystem that you're building for your clients. Your operational due diligence is important. It has to do with, is there high quality compliance? Do they have good market makers so the ETFs are liquid and stay liquid even when markets are tough? If you're doing a big trade, do you have the support of the capital markets team at the asset manager to help you find liquidity beyond what you just see in the bid ask on the natural, on Schwab or Fidelity or on the Bloomberg? There's often hidden liquidity in ETFs, but you have to know who to call at the asset manager to find out if that hidden liquidity is actually there today, or if it might be there tomorrow if it's not. And you need to think about co-investor risk, that there are other people buying this fund as well. And if there's one big, decision maker who has control over tens or even hundreds of millions of dollars of assets inside of a particular fund, and then that investment committee changes their mind and decides that, we're not going to use that fund anymore, we're going to use this other one instead. And then suddenly you see a quarter of the assets of that fund going out the door, and you are owning a larger and larger portion of that fund on behalf of your clients. You need to think about that and what you're going to do when that happens. All of those kinds of things fall under the role of operational due diligence in my mind.
What keeps you up at night?
We talked about this a little bit already. Markets are volatile. Unexpected things happen. Low probability events happen. When they do, it's stressful. Those are the things that could keep us up at night. But I think that those of us who have chosen to spend our lives being professionals in this space, that's part of the process. You're signing up for that anxiety, that uncertainty will exist, and you build a team around yourself and you find systems and tools that help you act rationally even when things get stressful. So I often find that while there is stress to the markets, it doesn't usually keep me up at night. But of course, there are times where things get particularly stressful, and perhaps it does a few nights then. But I've found the things that keep me up at night kind of all the time, even when markets are being kind to us, has to do with the humans that we work with. Clients become friends, friends become clients. We care for these people on a number of different levels. And there are so many times when the money can't solve the problem, but we're still in the thick of it with them, right? They have an aging parent, an ailing parent, or a sibling. They're worried about, the children are graduating from college and struggling to find their first job. Right. These are real human problems that money can make easier, certainly in the case of healthcare, but they don't make them go away. And we see our clients struggle through that. And because we have spent so much time getting to know them and understanding these things and what they want out of life, I often find myself thinking about these problems that we can't solve. And that's the kind of stuff that keeps me up at night. It applies to my team as well, right? I care about my team a lot. I'm friends with a number of them. I care about the work that they do here for our clients, and I also care about their careers and other parts of their lives, right? They fall in love, they get married, they have children, they have parents struggling, they get divorced, they have children who, are graduating from college and having a hard time finding their first job. I really care about these humans that I work with too. It's one of the reasons I love coming to this job and why I chose Exchange Capital Management over 7 years ago, is because I thought, these are some humans that I think I might actually want to spend a lot of my time with. I can't say that about all firms. So I care about them too. And that keeps me up at night.
It's a beautiful thing, to be a human and chief investment officer at the same time. So I'm guessing that you're sometimes in the odd position of grooming your team to actually leave your firm. Can you go into that?
Yeah, I alluded to that a moment ago, talking about managing their careers, right? We hire, not always, but a lot of folks we hire right out of college. We have a couple of financial planning positions. We have 4 people in the financial planning role right now. We have found that it's often very efficient for what we need out of people and for their kind of career trajectory to hire people right out of college, or maybe a year or two after, into that entry-level financial planning role. Then they work on thinking about the CFP, get some client-facing experience, and maybe someday they think about becoming a financial advisor. We also have that same entry-level role on my team as a trader. We don't need somebody with trading experience to hire them as a trader. We just need somebody good enough at Excel, with who's very detail-oriented and an interest in markets, and we will teach you everything you need to know. The tricky part is that if you hire intelligent, ambitious people, there's a very good chance that their careers will accelerate faster than the business does to satisfy the hopes and dreams and desires of their career. And so, financial planning, it feeds right into the advisor work. And if we're growing and gaining new clients, there should always be more work to be done there. On the trader side, it's a little bit tougher. And my thoughts on this apply to all of our entry-level positions and kind of going into mid-level positions, that saying out loud, there might not be the next step for you here at Exchange Capital when you want it. That's okay, right? Again, we don't know exactly what the future holds. You think about these things probabilistically. There might be the next opportunity when you get there, when you finish that certification, achieve that skill, figure out all the soft stuff around talking to clients and those things. We hope that that next position does exist. But if it doesn't, I don't think that the right thing for the firm or the team, let alone the human that we're talking about, is to lie to them about, we'll figure out that when you get to it. I'm sure we'll have something good for you. Just keep your nose down and keep working. And then when the time comes, then you give them the bad news, or maybe you obfuscate even more. Eventually, and again, an intelligent, ambitious person is going to recognize that you've been misleading them for years now, and they will find somewhere else to go, and they'll do so in a disappointed way. And then you leave on bad terms, and they tell the world about that, right? People talk about their experiences at other firms. I'd much rather handle it the other way and be radically candid with people about the uncertainty and tell them, here's what will probably happen. Here's another thing that is almost as likely. And then here are a couple of low probability examples of what could happen. And I do that in the interview process. I'm just radically candid about the uncertainty and explain to them what I am here for as their mentor and leader, and sometimes even direct manager, and how my door is open and they should come talk to me. And this will be a conversation that starts now in the interview phase, will continue throughout your entire employment here at Exchange Capital. And if we collectively realize together through those conversations that, oh, because of the particular time that you started and how the firm has grown over the period of time since then and where your career is lining up, oh yeah, that probability of promotion is actually pretty small now, because it just doesn't make sense for us to elevate another person to that level at this time. But clearly what your career needs sometime in the next year or so is to go do that job. Let me help you. I have a lot of folks that I know here in Southeastern Michigan and beyond. I'm friends with lots of them. Let me introduce you to the firms that I think might be good fits for you, because now you've been with us for a few years. I know you well enough that I know, oh yeah, you'd love working for them and you really wouldn't be a good fit for there. And let me introduce you to them and talk and see if there's a better fit there. And then even if they end up leaving, it's bittersweet, because obviously they're a high quality employee or we wouldn't be having these conversations, right? And we'll be sad to see them go. But I'll also be happy that they're doing what's right for their career and they're leaving on good terms. And maybe we'll get them back in the future when things at our firm change and things in their career change. I have a lot of examples now over the past 7 years where that method of doing things has led to a much higher quality experience for the people who have stayed and the people who have left. And I think that people really appreciate the honesty, even in the uncertainty. They appreciate the honesty and they're willing to work and have the dialogue about, yeah, okay, I understand that there isn't that next thing for me right now. I'm hoping that maybe that will change, but in the meantime, I'm going to go open a search. I say, yeah, that's great. I'll help you. And then they stay sometimes, right? They kind of see what else is out there and they're like, actually, I think I'm going to be patient here at Exchange because I'd rather roll the dice on things working out here than making a big shift. That's okay too.
Like a win-win.
Indeed. Again, radical candor, probabilistic thinking. I think when you put those two things together with other people who you do have to be able to tolerate the uncertainty, right? That is the uncomfortable part of all of it, is that you have to be willing to and able to tolerate the uncertainty. But that is life. Life is uncertain. And I've found it makes managing people easier. It makes managing their careers easier, and it makes the entire process more joyful and collaborative than it is otherwise.
Thank you for that, Andy.
Mm-hmm.
That's Andy Stewart. He's Chief Investment Officer of Exchange Capital Management.